Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, April 14th, 2025. So let's review the economic activity, the data that was released last week, which generally speaking, I think was pretty positive. And we'll take a look at the returns last week, very volatile, a little preface there, and then take a look at the economic data expected to be released this week. So last week, we got really good news on Thursday in terms of inflation. So inflation has been a huge focus, particularly since early 2022 when the CPI spiked up to 9.1% and has come down and now is pretty sticky right around the 3% range. But last week, we got the CPI and core CPI numbers for March, and it was very favorable. So the month over month was expected to be a positive 0.3%. It came in at a positive 0.1%. Hugely favorable. So it took the year over year down from the consensus of 3.0 down to 2.8. So that was really good news. The inflation, that was the core rate, the inflation rate, the headline number, equally good. That the headline number was expected to be up 0.1%. Month over month, it was down 0.1%. So great news. Also on the same day, initial jobless claims came in exactly as expected. For many of you, including me, I would have expected these numbers to be spiking with the DOGE efforts and other corporate actions taking place. But again, I mentioned inflation has been sticky at a certain level, 3.0. It seems like the initial jobless claims has been very sticky at that 215 to 230,000 a week. So last week, Friday, more good news on the inflation front. The PPI, Producer Price Index, that month over month came in for the month of March at a negative 0.4. Expectation, positive 0.2. So that takes a year over year from the 3.3% expected down to 2.7. So that's the headline number. Core number, again, that's also very favorable. Expected to be up 0.3% month over month, down 0.1%. So that will work through the pipeline. So both of those data points, CPI, PPI, look really good. Good for the inflation-concerned individuals out there. Lastly, last week, now this one's negative, has been for some time, the Michigan Consumer Sentiment Number. Comes out monthly, very quickly after each month end, came out for the April month. The expectation was roughly, 54.5, came in at 50.8. So it's been disappointing the last few months. Now, I'll throw only one caveat in here. There are a number of reasons why it would be going down as much as it has. Certainly, investors, consumers are a little bit rattled about the economy, about tariffs, all that. But there is one other explanation that we don't have fully, it's not fully understood. Just over a year ago, University of Michigan actually changed the way they did the survey. I think they completed the change in June. So it really renders looking year over year at this point so far kind of useless because the average drop, there were two research items done on the change and the impact. Even the University of Michigan indicated that the new methodology, which was going from voice surveys to online, internet, email, University of Michigan said it took on average decrease the level by 6.6%, and an independent third party looked at it and said it looks like more like 10 off the top. So not good month over month for sure. Again, the consensus expected to be around 55, came in under 51. But that 51 level, I hesitate to compare that against last year, 2 or 3 years ago, because the methodology is different. The numbers are not apples to apples any longer. A few other things from last week. The Atlanta Federal Reserve, their GDP number for the first quarter we've been reporting has been horrible. It just turned on a dime and went from positive, call it 2.5%, down as much as nearly 4% at one point. So their expectation for first quarter GDP, which ended March 31st, is a negative 2.4, which is an improvement from a week before at 2.8. The big driver on the Fed survey is how GDP is calculated. Net imports is a part of the calculation, C plus I plus G, so consumption, investment, government, plus net imports. And so when we import, that actually is a negative to the GDP calculation, exports positive. So the fact that the U.S. has been buying gold, has made a huge swing in that net import factor. So if you strip that out, the Atlanta Federal Reserve is still at a small negative GDP for the first quarter, but it's closer to flat than it is negative 2.4. So that's the real driver. Inflation expectations last week, it dropped a little bit now. Actually, it increased a little bit last week. It dropped significantly the week before, but it's at a very, very good level. It's at 2.20%. That's the expectation of inflation average for the next 10 years. We've had some periods recently that have been a little bit below that, but again, 2.2% annual inflation sounds pretty good to most market participants, I would say. Fed funds. So for the Fed meeting coming up in May, early May, I think it's May 7th, the expectation has actually dropped in terms of expectations of getting a cut. Just a week ago, 62% chance of not getting one, so 38% chance of getting it. Now, only 17% chance of a cut in May. And then when we look out to the end of the year and total up all the probabilities, the odds now of 2 cuts, that decreased from 90% just a week ago down to 73%. And the probability now of 3 cuts, which over a week ago in our last podcast was over 50%, is now 40%. So market is really pricing in 2 cuts at this point versus 3 just a week ago. Lastly, bullet points in terms of the economy, data points we got last week. We're starting to see first quarter profitability being announced by U.S. large corporations. It always starts off with the banks, mixed to slightly positive. Bottom line is the expectation for profitability growth in the first quarter is 7.2%, but that's almost always understated. When you go through any given quarter, roughly 75% of companies beat earnings per share expectations. So you can really add on at least another 3% to that 4%. So the expectation now is corporate profits in the first quarter, despite all the doom and gloom, negative activity that we've had in the last month, first quarter still looks like the profitability year over year for the S&P 500 companies is going to be closer to 11%. So last week I mentioned volatility, and we've had plenty of it the last 3 weeks. Last week, positive volatility for U.S. stocks, great. S&P 500, banner week, up 5.7%. NASDAQ, which had been beaten up year to date, NASDAQ was up 7.3%. So to put it in context, that's 7.3% that the NASDAQ rallied last week. On a year-to-date basis, it's still down 13.4%. So we felt a lot of pain. Last week was great. This week is starting off so far good. But both the NASDAQ and S&P 500 up huge during the week. Then we take a look at the growth versus value, and value has by far outperformed year to date. Last week, value had a really good week, up 3%, but growth up 6.8% last week. International stocks, developed markets ex-US, decent week, up 1.1%. But emerging markets, which had been performing really well, took a hit, down 3.9%. And China in particular, which had a huge surge between late first quarter and the second quarter, that was down 7.9%. Chinese stocks last week. So now on a year-to-date basis, China stocks still up 4%, but way off their highs of just 3 weeks ago. Fixed income, maybe the bigger story last week. Fixed income hammered. 2-year yield was up 32 basis points, the 10-year up 48 basis points. So the investors that 2 weeks ago flooded from stocks into bonds, the reverse happened last week. So it sent the Bloomberg U.S. Aggregate Bond Index down over 2.5%, and now on a year-to-date basis, the Bloomberg U.S. Aggregate Bond Index up, but only 1.06%. Let's take a look at the economic activity to be reported this week. Starts really on Wednesday, and pretty week light calendar. But on Wednesday, we get retail sales month over month and retail sales ex-auto month over month. It is for the month of March, lagging a bit. But retail sales, the headline number is expected to come in a positive 1.4% month over month. For the month of February, that was only positive 0.2%. Retail sales ex-auto expected to be up 0.4%. The month of February, it was up 0.3%. Lastly, Thursday, we get building permits, housing starts. These numbers, again, just do not move the market. Building permits expected for the month of March to come in pretty much where it came in February, 1.45 million. Housing starts expected to be a little weaker than February. February was 1.5 million, expected to come in at 1.42 million. And initial jobless claims, which again has been nice and sticky at this point, is expected to come in exactly where it was last week. New claims, 226,000. So that is it for this podcast. We just thank all of you for watching. We'll look forward to seeing you again next week. Thank you.